Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, while that's common, that's not the only way of doing it. And depending on what you observe in the market, and depending on the volatility levels of each option involved, and depending on some other things, you may elect to sell the longer-term option, and buy the shorter-term option. So I just kind of wanted to throw that out there for those of you who are accustomed to thinking that the only way to trade these is to buy the long-term option. It doesn't matter. A long calendar spread, which is when we buy the long-term option and sell the short-term option, is generally looked at as a time play. Okay? The idea is that the shorter-term option loses its value at a faster rate than the longer-term option, and because you're short that option that loses its value at a faster rate, as time passes, you collect time decay each day, and you profit through the Greek theta. The trade-off here is that, it's kind of what you might call an income-generating strategy, and there are a few other alternatives to those out there, like condors and butterflies and credit spreads and such. And the thing about income strategies is that you have positive theta, and you do profit from time decay. However, you have what is called negative gamma. That's sort of the fancy term for the problem that if the market moves too much in your currency, then you can lose big time. Well, reasonably big, I guess, in comparison to what you can make. And we're going to go through some examples to kind of illustrate that in just a second. So with long calendars, you benefit from time, and you are hurt from volatility, from the underlying currency moving too much. Now, it can also be a volatility play, and that's what I sort of alluded to a little bit before. When, for example, the back month or the longer-term month has a volatility that you perceive to be inexpensive compared to the shorter-term option, there might be an opportunity to profit from this perceived volatility discrepancy by buying the longer-term cheap volatility and selling the shorter-term expensive volatility. Now, you would still benefit from time passing, and you would still be hurt by the underlying currency moving too much, if it does, but you'd be looking at a little bit more sophisticated. And to be sure, you can kind of combine these two philosophies of trading long calendar spreads, and I would encourage that. And in the example that we go through, I'll be sure to kind of talk about both of these philosophies in trading. Short calendar spreads is when I sell the longer-term option and I buy the shorter-term option. And I know from talking to the thousands of traders that I've talked to over the past few years that, a lot of people are sitting there thinking, what? Wait, you can't sell the longer-term and buy the shorter-term? That's crazy. You have time decay working against you. Well, this is true. Well, it's half true. It's not crazy. But you do have time decay working against you. But just like with the long calendar spread, how time decay helps you and the volatility of the currency hurts you, well, it's just the opposite here. In this case, if the underlying currency sits still, well, then you get hurt by time decay, but if it moves a lot, well, then you can profit from that volatility. Now, that's what we call profiting from the realized volatility or the statistical volatility of the currency itself moving. But again, you can also profit from the implied volatility being mispriced. Now, there is a question here from Ray that says you use, quote, mispriced volatility, end quote. Is this the same as volatility skew? This is a great question. And despite the fact that I did kind of say I'd save some questions until the end, this is a great time to talk about this. Volatility skew can exist in a couple of ways, and some of you may have heard of this, and you may have heard of this being where the volatility of different strike prices can be different even on the same currency or the same stock or whatever. But there's also a volatility skew or term structure. That's what I was referring to before. The volatility skew for the months or the term structure of volatility for each month can be different. So right now, the January options of some particular strike price and the November options for the same strike price on the same currency could be different. The Nov and Jan could be different. One could be more expensive than another. Now that's what's referred to as volatility skew or volatility term structure. Now I'm using the term here mispriced volatility. Just because a skew exists doesn't mean that the volatility is mispriced. Now I've incorporated, just a few slides from now, some volatility charts. And I'm going to talk about some ways that you can try and identify mispriced volatility in comparison to just a simple normal volatility skew. So this is really important. Just because they're different doesn't mean that they're out of whack necessarily. Now let's walk through the first type of calendar spread that we could think about trading, the long calendar. All right, so once again, we just talked about this. Here's where we buy the long-term option, sell the short-term option. They're both calls or they're both puts, and it's the same strike price. Incidentally, kind of some trivia, if they were a different strike price, we would refer to that as a diagonal spread. Okay, a diagonal spread is when there's two different months and two different strikes. So, when we have a long calendar, it's an income trade. We hope to benefit as time passes by our theta that we generate. And I'm going to show you the Greeks of this example trade in just a second. And if we do this right, and we look at this intelligently and not just, kind of two-dimensional, but really dig down deep, we will also benefit by buying a lower implied volatility and selling a higher implied volatility. And that's really important if you want to be successful in the long run with time spreads. Always, always have to study the volatility. Okay, so let's look at an example here of the euro. So in this case, the symbol is EUI, and we make some observations. And we'll see the chart in a second. We observe that the volatility is a little lower than it was in recent past. And we study the volatility charts, and we look for a volatility setup that might be conducive to buying a time spread. So here's what I teach in my mentoring, and I kind of have a whole system of talking about this, which is what I call the market taker mentoring trading path. For whatever it is you're trading, currencies, stock options, whatever, you always have to take these steps. Now again, I don't have time to go through all of it, but I want to make sure that everybody kind of thinks about trading, especially these time spreads, correctly. All trading is about getting edge, okay?
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.